Good evening, everyone. My name is Kay Byington with the Student Money Management Center, and I'm really glad you tuned in. Here's a short introduction to our speaker tonight. We're going to be joined by Sergio Gonzalez with Sallie Mae. Sergio joined Sallie Mae in 2005 and is currently a director of business development responsible for supporting colleges, universities, and high school organizations in Texas, as well as in New Mexico. Sergio has been in higher education since 1995 with 10 years of experience in financial aid. He's fluent in Spanish and resides in Houston, Texas with his wife. Go ahead, Sergio, and let's get this going.
Great. Thank you so much, Kay. I appreciate it. And thank you all for joining tonight. My name is Sergio Gonzalez. I'm also accompanied with my colleague, Elise Sanders. We like to tag team these presentations just because when technology works, it works. And when it doesn't, it doesn't. And we want to make sure that one of us can pick up the slack if Wi-Fi goes out or what have you. But this is very informal. So what we'll do is we'll go ahead and go through the presentation. And then at the end, we can open it up to any questions through the chat. So with that said, let's go ahead and get started. So a few things we're going to cover today. We're going to go over your loan portfolio. And specifically, we're going to go over loan repayment strategies because we know that you're probably about to graduate and you're probably having that conversation and starting to think about, well, how am I going to pay this back? And what are my options? And what happens if I can't pay back? So hopefully, this is what you're going to get out of this presentation today. So we'll go over your loan portfolio to determine what type of loans you've borrowed. We'll also go over important decision points on the calendar when you should be aware of. So when should you start paying back? How long do you have to pay back? And then also, if I have troubles paying back, what options do I have to be able to postpone payments? So we'll go over deferments and forbearances as well. And then we'll go over the different repayment options that are available for you as well, because we know one size doesn't fit all, so the federal government has given you quite a few choices for you to be able to choose from. And then lastly, we'll provide you with some available resources that are available for you to help you in your success in repaying back your loans. So let's start with the basics, and I'm going to turn this over to my friend Elise, and then I'll come back in just a minute. Thank you.
Thanks, Sergio. So let's start out with knowing your loan portfolio. First, you need to know what types of loans you have. Do you have a federal education loan like the direct student loan or Perkins loans? Do you have private loans, which are also called alternative student loans? It's important that you make a list of the loans and any relevant information about them. You really should know who services your loans. So federal and or private loans may not be with just one servicer. Some of the Department of Ed servicers we've listed on this page includes Great Lakes, Navient, Nilnet, Federal Loan Servicing, also known as FIA, and there are others that we're going to share a little later on in the presentation. So borrowers must be notified if the servicer changes on their student loans. There are two types of federal direct loans. There's subsidized and unsubsidized loans. The difference is what happens to the interest. Subsidized loan interest is covered by the federal government while you're in school. They also cover the interest through your grace period and during any deferments you might have. For unsubsidized loans, the borrower is always responsible for paying the interest that accrues on the loan. Even though you don't have to make an interest payment during the in-school period or during your grace period or even during a post-school deferment, interest is still accruing. And borrowers can pay the interest at any time up until the end of the grace period to avoid interest capitalization. And we're going to show you a little later on in the presentation what happens to a loan when it capitalizes. And just so you know, private loans don't offer any interest subsidy. So where can you find out information about the loans you might have? Finding your federal and private student loans is pretty easy to do. For federal loans, you can find information on your loans by going to the Federal Student Aid website, studentaid.gov, and just log in. Private student loans are reported to the National Consumer Reporting Agencies, So you can find your private loans by going to the annual www.annualcreditreport.com's website. You can also use one of the 3 national credit bureaus to find information about your private student loans. These are the 3 national credit bureaus, along with their web addresses and phone numbers, to make it easier for you to locate your loans. And as I mentioned on a previous slide, there are some additional servicers the Department of Education is contracted with to handle repayment of your loans. There's no difference between the servicers because the guidelines are outlined by the Department of Education as to how the loans must be serviced. And you can see a few of them on this chart. Next, we're going to talk about the cost of student loans. There are a few important things you need to know. First, what is an interest rate? Well, it's the rate charged to borrow money. And obviously, the higher the interest rate, the higher the total loan cost. What's capitalization? Well, interest capitalization occurs when unpaid interest is added to the principal amount of a loan. So it increases the principal amount. So think of it as a snowball. As a snowball goes down a hill, it gets larger and larger. And that's what happens to interest when it capitalizes. And what are repayment incentives? Well, repayment incentives can include interest rate reductions or credits to your loan balance. And some benefits and repayment incentives impose eligibility requirements. So make sure you understand the requirements so that you don't miss out on any of the opportunities or incentives. This chart provides rates and fees for the federal loan programs. So let's take a look at it. Undergraduate subsidized and subsidized loans, graduate unsubsidized loans. There's information here about both parent and graduate plus loans, consolidation loans, and some basic information about private student loan rates. Federal loan rates and fees vary from year to year. The actual interest rates change every July 1st and are effective through June 30th of the following year. The loan fees, however, change every October 1st and are effective through September 30th of the following year. You can see, and you can see on the chart some of the interest rates. So let's just take a look at the undergraduate subsidized and unsubsidized loan rates was 4.53. And that was as of 10/1/19 through 6/30/20. And then those loans had to have dispersed between 7/1/20 and 9/30/21 to have gotten an interest rate of 2.75%. And then you can see the 10/1/20 rates of 2.75. And as you can see, the fees changed as well. They have gone down a little bit. Next slide, Sergio. So let's talk about interest capitalization. Interest capitalization occurs when unpaid interest is added to the principal amount of a loan, increasing the principal amount that's outstanding. I mentioned before that we were going to share some information about the impact. So this is an example of interest capitalization, and it helps to explain the difference between someone that paid their interest while they were going to school versus someone who deferred their interest. And as you can see, once the loan capitalizes, the loan becomes much more expensive. So on the first example on this loan, the student borrowed $50,000. The amount of payment is $582, and the total amount is going to be $73,453 and change. So there's a total interest cost of almost $20,000. Now, if you have chosen not to pay the interest, and this is assuming a 7.08% interest rate, that same $50,000, interest that was building while you were in school totaled $17,700. It gets added to the $50,000, and now the new loan amount is $67,700. Your payments out of school is going to be $788.85. The total amount you're going to pay on that same $50,000 is $94,662. So the total interest on that loan is almost $45,000. It's a pretty big impact. Okay, next slide. Borrower benefits or repayment incentives are money-saving benefits that lenders typically offer to borrowers. Where can you find information about your benefits? A good place to start is your online account, assuming your lender offers an online account management service. Some of the borrower benefits or repayment incentives on private loans can include things like interest rate reductions, credits to your loan balance, and it can even be cash rebates. Make sure you know the benefits, the terms and eligibility rules, as I mentioned before, so that you don't miss out. Okay, now I'm going to turn this back over to Sergio.
Great, thank you, Elise. So now I'm going to go over the different repayment options that you have. As I mentioned in the beginning of the presentation, that one size does not fit all. So the federal government has created different options for you to choose from depending on your situation. So let's start with paying your loans off early. So there is no penalty whatsoever if you've chosen to pay your loans off early. So if you said, okay, I finished school and my goal is to pay this off in a year, perfectly fine. If you had a 10-year term and you paid it off in a year, there's no penalty whatsoever, so you're able to do that. If you can do that, it's always encouraged because it minimizes, again, some of that interest that Elise was talking to you about. But if you're able to pay it off early, great. If not, if it takes you 10, 20 years to pay it back or whatever the term they've given you, that's quite all right. But again, you always want to strive to try to pay this off early. And then grace period. So every student is entitled to a grace period. So this is a period of time between you graduating and then going into repayment. You get a 6 months grace period. So basically from the date that you've graduated, you will start making principal and interest payments until 6 months from that graduation date. But have you though understand that if you decide to go to grad school, and if it takes you longer than 6 months to transition from undergrad to graduate school, then that grace period on your undergraduate loans is gone. So what that means is when you finish graduate school, you're going to go into immediate repayment when you graduate graduate school because, again, your grace period is over for your undergraduate loans. But if it takes you less than 6 months to transition from undergrad to grad, that 6 months will still be there when you graduate graduate school as well. But just remember that you do have that period of time, and this is a time where you want to make sure that you get an understanding of what your options are to pay and creating a plan for yourself and budgeting yourself accordingly so that you can be successful in paying these back. So if ever you have any troubles in paying back your loans, life happens and sometimes you have to postpone payments for a period of time, and you have two different options. The first best option is a deferment. You have to apply for a deferment and you have to be approved for a deferment in order to qualify. And there's various types of deferments that are available for you. So for the example that I shared with you, that if you want to go to grad school, then you can do what is called an in-school deferment. As long as you enrolled at least half time, you can defer your loans until after you finish graduate school. So that's one type of deferment. Or let's say that you've graduated and you're having a hard time finding a job. So you can do what is called an unemployment deferment. Or let's say that you do have a job, but your debt to income ratios are really off and you're having troubles paying this back. You can apply for an economic hardship deferment as well. Of course, you'll need proof of your income and your debts to see if you qualify. And maybe you're in the military, you get mobilized, you can also defer your loans because of that situation as well. And then the other option is a forbearance. Similar to a deferment in that you can postpone payments, but this one you don't have to do an actual application to apply for postponing payments. This one you simply contact your servicer and tell them, hey, I'm having some issues and I need to forbear my loans for 6 months, and they can do that for you. So what's the difference, or what's the benefit between a deferment and a forbearance? Remember that I said to you, if you qualify for a deferment, you always want to do that first. Well, why? The reason is If you had any subsidized loans that are approved for a deferment, then the federal government will pay interest on those loans while you're in a deferment status. Whereas in a forbearance, all loans are accruing. It doesn't matter if it's subsidized or unsubsidized. So that's the big difference. So always remember, try a deferment first. And if you don't qualify for that, then the next best thing would be a forbearance. And then delinquency and default, which none of you are going to do. You're considered to be in a default status when you are 270 days past due. So that's a long time with you not communicating with your servicer to let them know that you're having some troubles, right? And there's really no reason for anyone to go into default because the servicer is there to help you through any situation that you have, that maybe they can look at doing a different repayment plan or doing a deferment for a period of time or a forbearance to help you postpone payments to get back on your feet. So if ever you have any issues at all or any troubles in paying back your loans, keep in contact with your servicer. So what happens to you when you default on your loans? If you default on your loans, the federal government can sue you. Your credit, of course, will be ruined. Your wages can be garnished. So how embarrassing it is that your employer is having to pay you and the federal government because you defaulted on your student loans. Tax season is upon us, and maybe you're waiting for that tax refund check to come in the mail. Well, that's not going to go to you. It's going to go to the government to pay back for the loan that you defaulted on. And if you need a license to practice your specific profession or career that you're in, those will not be able to get renewed because you defaulted on your loans, right? So there's no way around this, right? I always get the question, well, what if I file for bankruptcy? Does it go away? They do not. These loans will be with you until the very end, right? So I also get that asked the question, well, is there any way that these loans can go away? And yes, there are. There are two ways. They're not the best ways, but there are two ways. One is you die, and the other one is you become totally and permanently disabled, which are not the best options for these loans to go away. So again, any change in your status, keep in contact with your lender or your servicer. Any changes in your status, as in, ladies, if you get married and change your last name, let your servicer know that. If you move and change your address or your email address, let your servicer know that. If your social security number changes as well, let your servicer know that. Again, just keep in contact with them whenever there's any change in your status. So let's get into different repayment options that you have available for you. If you do nothing at all during your grace period and don't choose a specific option that you want, the federal government would automatically put you in a standard repayment term. And basically, this is a set amount monthly for 10 years, right? It's probably the most effective overall and lower cost for students. And I would definitely recommend that most undergraduates do this repayment option because it's a shorter term, it's still long enough. But if you borrowed less than $30,000, then this could be a great option for you. The other option is a graduated repayment plan. And this one is also a 10-year term. But the difference here is that you start with small payments and then gradually start building up to larger payments. And how students utilize this particular benefit is that maybe you have higher interest credit card debt that you want to make more payments on than your low-cost federal loans that you have. That you can start making payments in the beginning larger on your credit cards and then start making smaller payments to that. But do remember, it's kind of a balloon effect, this particular option, because remember, it starts off small and they have to finish you off in 10 years. So eventually the amount to pay back is going to grow. So just keep that in mind. And then if you borrowed more than $30,000, then this would be the next best option, right? This is basically a 25-year term, set amount monthly for 25 years, right? Most graduate students gravitate to this particular option because they tend to borrow a little bit more than an undergraduate student. But this is an option that's available for you. So what's the positive of this? The positive, let's say that for the standard term, you borrowed $50,000 and your payment is about $500, just as an example. Maybe that's not as manageable for you. So with this one, if you do 25 years, that $50,000 with the $500 payment has now become $250 because instead of 10 years, it's 25 years. So that's the positive, is that your payments are smaller and more manageable. The negative is that if it takes you 25 years to pay that off, that $50,000 that you borrowed has now become $100,000 because it's taking you so long to pay it back. But remember that if you're able to pay it back sooner than later, you can without any penalties whatsoever. And then the next options that are available for you, there's quite a few of them. They're all income-driven options, right? So there's the income-based repayment option, there's the pay-as-you-earn repayment option, there's a revised pay-as-you-earn repayment option, and income contingent repayment plan. So all of these are very similar. There's some differences here and there, but basically all of these options are going to ask what is your adjusted gross income and your family size. And it's going to be based on your income to determine if you qualify for these particular repayment options. And if you do qualify, then you can take advantage of these. And then most of these, after 20 or 25 years, whatever balance remains, the federal government will forgive whatever balance remains. But do know that whatever is forgiven under these income-driven options, they are taxable, right? But this is an option for you as well. But do remember, though, that as your incomes grow, you may not qualify for these options anymore, which is why then maybe you start with one of these and then they say, well, you don't qualify anymore. Then you can switch to another repayment option. So you do have the option to jump around on some of these repayment options that you have. And then consolidation is probably not a big thing anymore. Back in the day, students were able to borrow through different banks. And what was happening is that every year a student was borrowing through a different lender. So when they went to graduation, they had different servicers that they had to pay back, and it was a little bit unmanageable. So the federal government created a consolidation program where they said, okay, we'll take all of your loans, make one new loan to help you make one payment to one person only. And they take all the interest rates that you had on all your loans, find a fixed weighted average, and lock you in at that rate. But at this point, as Elise mentioned to you earlier, what the federal government has been trying to do is keep every student with the same servicer. So for undergraduate school, you have a certain servicer that if you decide to go to grad school, they're going to try to keep you with that same servicer, so you have one payment to one person. In the situation or case that you are given a different servicer, then consolidation may be the option to go if you want to make one payment to one person only. And then for consolidation, it's a 30-year term. So basically, it's similar to the extended in that your payments are more manageable, but if it takes you 30 years to pay it back, the amount that you've actually borrowed has doubled because it's taking you so long to pay back. And then this is just a chart to show you an example of a student who borrowed $45,000. $19,000 of that was subsidized and $26,000 of that is unsubsidized at a rate of 5.05. So you can kind of see what those payments look like, right, for all of the different options that we kind of discuss. And then it tells you when it's all said and done, what is the total loan amount that's going to be paid back. And you'll notice that the standard, of course, is the most lower cost-effective option for students, because that $45,000 is about $470 a payment a month, but the total amount paid will be about $57,000. Whereas an extended plan, your payments are much smaller, about $188, but the total paid back would be about $86,000. So just keep that in mind when you're looking at these. And the great thing too is that all the servicers have calculators available for you. So you can start plugging in those numbers and start figuring out what your estimated payments are going to be on all of these different repayment options. So you can go ahead and budget yourself accordingly and be more prepared when you go into repayment. And then federal loan forgiveness is another option that's available for students who want to work for not-for-profit, low-income sectors. A lot of teachers, medical professionals, lawyers take advantage of this, or people who work for not-for-profit organizations. Basically, what it is that after 10 years of making on-time payments, whatever balance remains, the federal government will forgive whatever balance remains. But you have to have certain loans that are eligible. So of course, all the direct subsidized and unsubsidized would qualify. And no private loans would fall into this. This is just for federal loans. And then you have to be in a certain repayment option to qualify. And the repayment options are all the income-driven options that we talked about, and also the standard repayment term. And basically what's going to happen is your employer is going to fill out this form for you to certify that you're employed full-time And then you're going to make a copy of this and send it off to the federal government so that they can check to see if that organization that you're working for is approved. And if they are, and you're going to do this on an annual basis on the 10th year of approval, and then whatever balance remains after the 10th year, then any balance will be forgiven. But I will tell you, you have to be very meticulous with this. You cannot be late one day in payment. You have to be in the right repayment option. If you're not, and you move to a different repayment option, then you no longer qualify. So you want to make sure that you're very specific with this and be very careful, because I will tell you that only 5% were approved and 95% were denied. So you just want to be very careful and meticulous, and I put a website there to learn more about public service for you as well. And then if you had any private loans, these are different than federal loans, right? So there are different repayment options that may be available for you. There's usually forbearances and deferments that may be available. There's grace periods normally through a lot of the private loans as well. They try to mimic as much as possible the federal loan programs, but just look at your terms and conditions on your promissory note on your private loans to see what kind of repayment options are available, or contact them, again, if you're having any issues paying back these loans. And then you're able to get some interest deduction on your student loans. You can get a max of $2,500 per year. You can get a full deduction if you're single, making $70,000 or less. And then you can get a full deduction if you're married, if you're making $140,000 or less. But if you're making $85,000 or more as a single person, no deduction. And then if you're married making $170,000 or more, you don't get a deduction as well. But take advantage of this if you qualify. And now I'm going to turn it quickly back to my friend Elise here.
Thanks, Sergio. So lastly, we're going to provide you with some helpful tips so you'll know how to manage your student loans. First, most important thing is to keep good records. And by being organized, that's going to help you more easily keep track of your loans. Make sure you have copies of your promissory notes, your disclosure statements, and all of your award offers, along with a copy of your exit interview information. That's going to help you know what you owe and when you need to start making payments. Open and read all of your student loan information. It's helpful to bookmark your loan servicer's website so that you have easy access to them. And along with their website, you might want to keep their phone numbers available as well. And if you move or change your name, as Sergio mentioned before, you want to make sure that you notify your loan servicer as soon as possible so that they have the most current information about you in their database. And keep careful notes on any calls you make to your servicer. I always recommend that you get a contact name of the person you spoke with so that you have a reference. So if you have an issue, you can say, I spoke with Sergio and this is what he shared with me. And then intuitmint.com is a great resource for budgeting and keeping track of your debt. And they have a variety of other things as well that you might find helpful. Remember, the most important thing is you're not alone. So there are a lot of great resources for you to know about. Your financial aid office will always be available to help point you in the right direction. And your lender and servicer is always available to help answer questions as well. And the Federal Student Aid Ombudsman is also a great resource. You can reach out to them by using their website, which is www.ombudsman.ed.gov, or you can call their toll-free number, which is 1-877-557-2575. And we've also provided the larger federal loan servicers information on this slide. So there's information about Great Lakes, My Fed Loans, Nelnet, and Navient. And lastly, another resource is Federal Student Aid, which is studentaid.gov. That's a really important contact for you. Now we're going to share some final tips for managing your loans and finances. So you might find it helpful setting up auto debit so you never forget to make a payment. And by making payments regularly rather than deferring your loan or placing them into forbearance, that's going to mean that you're going to pay less over the life of the loan. We talked a little bit about capitalization and what that means. Making a larger monthly payment each month will also help you pay your loan off faster. And you might want to create a budget. Keep track of your expenses. By cutting out some of the unnecessary purchases you make, you can use those funds to pay off your student loans faster. If you fall behind or you have any issues in making your payment, it's best to reach out to your servicers to see if they have any flexibility in your payment. And something I always recommend is build an emergency fund. So you have money to cover the unexpected things that might arise. Things happen in life. End up with a flat tire, you can get a ticket. You don't want to be stretched to the penny where you can't make your student loan payments. So try to build in a contingency fund. Be aware of scams that offer to lower your loan payments. When in doubt, contact your servicer. And make sure your loan servicer, as we mentioned before, has the most up-to-date information about you so they can stay in touch with you. And now we're going to open it up to any questions you might have.